This channel, this thing of ours, is primarily a socioeconomic channel. Now, socioeconomics is a softer discipline than the so-called dismal science of economics. It's one that examines how economic activity and social structures influence one another. There's actually a long-standing debate as to whether economics is even a science, and I'm not sure I have the right answer to that, but what I can say is that economists tend to be better historians than they are at predicting outcomes. Now, true sciences deal in absolutes. They try to find explanations that are consistent and unequivocal. Every law of nature is distilled to an equation that can be used as a building block to understand the next thing. But in economics, even the most fundamental equations seem to be subject to interpretation and then co-opted by ideology. That's why there are so many disparate camps under this enormous tent. And too often, I feel like the discipline itself winds up being weaponized by jargon, like high-concept terms of art to explain basic behaviors or circumstances that should otherwise be accessible. So I find socioeconomics takes the math off the page and brings it down to a true human level. It helps us break from specific doctrines and be slightly less dogmatic ourselves. So today, I thought we'd take a break from the doctrine and the dogma to bring certain concepts down to a base level. And some of these concepts make my eyes glaze over, but all of them are important. Some explain why some things are the way they are, and others I find needlessly and perhaps deliberately complicated because they're designed to hide certain policies. But all of them impact our lives and how we think about the economy. So I put together 10 needlessly complicated, obfuscating highbrow terms that paper over how our world truly works. UNFTR. All right, number 1, financial repression. I've actually received a surprising amount of feedback and follow-up questions on this one because it's a pretty popular buzz phrase right now. Financial repression is when a central bank keeps interest rates artificially low, the thing that Trump has been screaming about, right? And typically below the rate of inflation. Now, the reason they do this is to erode the real value of its debt over time. That's the part of bringing rates down to zero that they don't talk about. It's a debt defense mechanism that theoretically helps out the federal government and in reality comes back to bite us all in the ass. So let me give you an analogy. Imagine you borrowed $100 from a friend in 2010 and you told them that you'd pay them back with interest, but the interest rate that you locked in at was 1% a year. Now, meanwhile, over the next decade, inflation runs at 3% a year. So when you finally pay it all back in 2020, you hand over the $100 plus the interest. But those dollars are now worth significantly less than when you borrowed them. So you paid back less in real terms than you actually borrowed. Now scale that up to a national government level with, $38 trillion in debt. That friend is everyone that holds U.S. treasuries. It's pension funds, foreign central banks, savers. And the government is slowly paying back less than it borrowed in real terms by keeping rates below inflation. So why start with this one? Why does it matter now? Why are you hearing so much about it in the financial media? And why are so many people following up with questions? Well, because for the better part of a decade following the financial crisis, the U.S. ran near zero interest rates, even as the debt was piling up. So if you're part of the saver class, like in retirement, financial repression is essentially a hidden tax. Now, it doesn't show up in your pay stub, but it quietly transfers wealth from creditors and savers to the government debtor. So now keep that in mind because everything we talk about today connects back to this one idea. Number 2, demand destruction. So this is when prices rise so high that consumers just stop buying or can't afford to buy, which then collapses the very demand that was driving prices up in the first place. Now, in a way, it sounds almost self-correcting. Prices go up, people stop buying, prices come back down. And sometimes that's how it works. That's how we go in traditional business cycles. This is just the market working the way it should, or so they say. But the way we get there sometimes is brutal. Take gas prices. Let's say they spike to $5 or $6 a gallon. At first, People are kind of pissed off, but they have to pay it because they got to go to work. And then slowly, and maybe all at once at some point, people just stop taking road trips. They consolidate their errands. They look into carpooling, business that depend on traveling and spending. They cut hours and jobs. And then the workers who lose those jobs buy even less. And you can see where this goes. The demand doesn't just correct like in a normal recessionary environment. It just breaks. And with it, a lot of that economic activity that people depended on also breaks. So this was the great debate in 2025, because a lot of people believe that if tariffs were fully implemented at the promised levels, which they never were, then it would utterly destroy consumption because price hikes would have to flow through to the consumer. Now, we're having the same conversation again with respect to the Iran war because oil, gas, petrochemicals, and fertilizers for feedstock and other uses are being held up in the Strait of Hormuz. And this is having a tremendous impact on prices at the sensitive top of the supply chain, with prices at the pump, for example. But protracted high costs for these valuable inputs to the entire fossil-based economy mean higher costs for goods and even services down the road. So we all pay the price. And when the price gets too high, then the consumer has the final say in shutting it all down. And that pullback in demand connects directly to our next term, because when consumers pull back and the economy slows, governments get nervous. And that nervousness shapes the way that central banks, and in our case, the Federal Reserve, thinks about policy, and it also shapes what they're allowed to do. Fiscal dominance. Okay, this one is critical. This might be the most important but least talked about term on this entire list to understand at least the moment that we're in right now. So fiscal dominance is when a government's debt load gets so large and the interest payments on that debt get so consequential that the central bank effectively loses its power to manipulate certain levers in the economy. Like, it can no longer make monetary policy decisions just based on inflation and employment. It has to factor in whether raising rates will blow up the government's budget. So let me make it concrete. The Federal Reserve is supposed to be independent. It's supposed to be able to just raise interest rates aggressively, let's say, to fight inflation, regardless of what that costs the Treasury Department. That's just the deal. Because the Fed has the so-called dual mandate, price stability and maximum employment. It's not keep the government's borrowing costs low, which we'll talk about more in a second. But here's the problem. When the U.S. is paying $1 trillion just in interest on its national debt, then every percentage point the Fed raises rates also adds hundreds of billions of dollars more to the annual tab. So at some point, the debt is so big that raising rates enough to truly fight inflation would trigger a fiscal crisis. The government just wouldn't be able to service its own debt. So what does the Fed do? It hesitates, like you're seeing right now. It raises rates slowly, more slowly than maybe it otherwise would have. It signals dovishness earlier. It keeps an eye on the Treasury market, even while claiming it only looks at the jobs and inflation data because it knows it has this other big job on the side. That's fiscal dominance. And it doesn't have to be overt. It doesn't require a phone call from Scott Bessent to the Fed chair. The math just itself does the constraining. So the debt load limits the Fed's options. And this is the Fed's worst nightmare, because once the market figures out that the Fed can't fully commit to fighting inflation, inflation expectations become harder to anchor, which makes inflation harder to fight, which makes the debt problem even worse. So this is the trap that Kevin Warsh is walking into. Now, once you understand fiscal dominance, you can understand why central banks sometimes resort to more drastic tools, which brings us to number 4. So this one is an interesting one because it's creeping back into the lexicon. It's something that we've done before. It's something that other central banks have also done. And if we wind up doing it again, it's a really bad sign. So I think that's why you usually hear about it in sort of hushed tones. Yield curve control. So yield curve control is a central bank policy where the Fed, in our case, sets an explicit ceiling on interest rates at a specific point on the yield curve. So it's going to cap rates at 3.5% for the 10-year Treasury, let's say. And it commits to buying unlimited quantities of those specific bonds to enforce that ceiling. So imagine you're a card player and you just announce to everybody at the table, I'll match any bet no matter how large all night long. That just changes everybody's behavior at the table because nobody's going to try and push you out with a big raise because they know you can't be bluffed. The credibility of your unlimited commitment is itself the policy. That's yield curve control in a nutshell. And by the way, Japan has been doing this for years, starting in 2016, actually. The Bank of Japan has used yield curve control to pin long-term rates to near zero in order to avoid a debt spiral because Japan's debt to GDP is off the charts. It's about 260%. So the Bank of Japan now owns more than half of their own bonds. And so why does this matter for us? Yield curve control is the logical endpoint of fiscal dominance. If the Fed ever finds itself unable to just let rates rise, like if the debt load made rate hikes existentially dangerous, yield curve control is the next tool in the box. It's literally the most extreme form of financial repression. So you're not just keeping rates low, you're capping them with unlimited money creation as the enforcement mechanism. After World War II, we did this. We did it briefly, but ultimately it had an inflationary impact on the economy because you're essentially talking about unlimited money printing. And even though it seems like it's contained within the bond market, you're still increasing the money supply, which over time begins to devalue the currency, which shows up as inflation. Now, because yield curve control is deeply connected to the plumbing of the bond market, it brings us even further into that world, and frankly, into a corner of it that very few people understand. Okay, so this one is genuinely obscure, but we've talked about it probably more than most other places because it's something that I find littered with clues. Now, most people, even financial professionals, don't really understand this, nor do they have to care about it. And the mechanics of it are above my pay grade, so let me be clear about that. But conceptually, I get it. This is the overnight plumbing of this system. And when it breaks, everything breaks. And one of the problems with it is the name. The word repo has a certain connotation. It's already in the financial lexicon. But in the world of central banking, it stands for repurchase agreement. So a repo is essentially a short-term collateralized loan. So a bank or financial institution sells a treasury bond to another party and then agrees to buy it back the very next day at a slightly higher price. And that small price difference is the interest on it. It's how big institutions actually borrow cash overnight. They use government bonds as collateral. Now, the reverse repo is the same transaction from the other side. You're the one lending the cash and holding the bonds temporarily. So think about it as like a pawn shop for banks. You bring in your treasury bond and you get cash just for the night, and then you go and buy it back tomorrow morning. And the whole financial system does this, mind you, every single night. They do it to manage short-term liquidity, hundreds of billions of dollars, sometimes trillions, flowing back and forth in a 24-hour cycle. And it's a relatively new invention designed to lubricate the system. It's very sophisticated, it's huge, and it flies mostly under the radar until it doesn't. Now, one time that it didn't was in September of 2019 when the repo market seized up because overnight rates, which are typically set by they're set by the marketplace. So these intermediaries are setting the rates themselves. The Fed has a suggested rate, but the rates themselves that the banks play between each other, it's always set by them. So in 2019, overnight rates, which were supposed to be around 2%, suddenly went to 10% because it turns out the system was just short on cash and it was long on collateral. So nobody was lending. So what the Fed had to do is they had to inject hundreds of billions of dollars overnight just to stabilize the whole thing. Now, the stock market reacted to it pretty negatively because people were freaked out. Most of us didn't really know anything about it because it was like it was just them handling their business, right? March of 2020, though, it really came to fruition. So when the pandemic hit, everybody ran to cash at the exact same time. So the treasury market, which is the deepest, most liquid market on earth, suddenly became illiquid. So the Fed, once again, had to intervene with, now this time, trillions in repo operations. And it's a testament to the Fed's effectiveness that most Americans don't even know that this was happening. They know that the government had to put cash into the system to make sure that everybody could clear stuff, right? But they don't really know the mechanics of it. But the repo market is the reason that we don't wake up one morning and just find that the entire financial system is locked up overnight. It is that foundational. And if we continue on the path of following the money in this way, then we have to talk about who all of these buyers, sellers, lenders, and suppliers are. And where does all that money come from? So you might have heard the phrase exorbitant privilege in reference to the U.S. as the world's reserve currency. What they're really talking about is the Eurodollar system and its sister, the petrodollar. So we'll take them one at a time. So the Eurodollar, and this one is always confusing because it has nothing to do with the euro currency, are U.S. dollar denominated deposits and credit held outside of the United States in foreign banks, so beyond the reach of the Federal Reserve. A Japanese bank makes a loan denominated in U.S. dollars. A German company holds a dollar-denominated account in London. A Brazilian corporation issues dollar-denominated bonds. None of these dollars are actually in the American banking system. The Fed actually didn't create them, and the Fed can't then, therefore, directly control them. They exist in this vast, largely unregulated, offshore dollar universe. And here's the kicker. The Eurodollar system is larger, a lot larger than the entire domestic U.S. banking system. The total stock of dollar-denominated credit and debt outside of the U.S. dwarfs what we have here, which means that most of the world's dollar activity is happening outside of the Fed's direct jurisdiction. Now, petrodollars are different and specifically important. The petrodollar system refers to the arrangement established in the 1970s by which oil, the world's most critical commodity as we're rediscovering in the current crisis, oil is priced and settled in U.S. dollars. So if Japan wants to buy Saudi oil, typically it pays it in dollars. If Germany buys Nigerian crude, dollars. If China imports from the Gulf, paid for in dollars. Now, there are workarounds today, and there will be certainly a lot more of them in the future, like Bitcoin, for example. But for now, this is the way of the world. And this creates a permanent, structural, global demand for dollars. Everybody needs dollars in order to buy energy. And the demand for these dollars is a core pillar of dollar dominance. It keeps the dollar as the world's reserve currency, which in turn allows the U.S. to borrow cheaply. It allows us to run these extreme deficits and to fund itself in ways that no other country could possibly get away with. So why does this matter right now? Because there is a genuine sustained pressure on both of these systems. BRICS nations, for example, we've talked about this one before. So Brazil, Russia, India, China, South Africa, and then the ever-expanding circle like Indonesia, they've been actively working to settle more and more trade in non-dollar currencies. Saudi Arabia's even floated the idea of purchasing oil in yuan. If the petrodollar dominance erodes, then the structural demand for dollars erodes right alongside it. And if this happens, the U.S. suddenly can't borrow as cheaply as it always has. So the deficit math, once again, changes. Now, importantly, the Eurodollar system is periodically fragile. So this is the one place where the Fed actually can play a role. When global dollar liquidity tightens, the offshore system can actually seize up. And that's why the Fed has opened up dollar swap lines with foreign central banks during crises. It's basically just to keep open access on the market for, banks to buy dollars. It's also, by the way, you might have heard recently that the Treasury opened up swap lines to UAE. That's what they were talking about infusing dollars into the UAE. It wasn't for them. It was for us. They actually didn't need the dollars. We need them to buy the dollars. So that's what a swap line effectively does. Now, in that case, it was the Treasury, which is a very limited amount. The Fed actually has no limit as to how many dollars it can create in these swap lines. So basically, in this case, it's the Fed acting as the global lender of last resort. Now, de-dollarization which could have been on the list itself. Maybe we'll talk about it again another day. De-dollarization is a serious threat. It's not going to happen overnight, but it's not happening at zero right now either. And understanding Eurodollars and Petrodollars tells you why it matters if it does happen. So, if you understand that the government needs global demand for debt to stay cheap, and if you understand fiscal dominance and yield curve control and financial repression, you begin to understand how the line between central bank policy and just printing money to pay the bills gets very, very thin. So let's talk about printing money. Okay, debt monetization is when a central bank buys government debt, treasury bonds, and effectively just creates new money in order to do it. Now, it sounds like yield curve control, and I guess it's adjacent, but the rationale for doing it is very different. Like yield curve control is just attempting to manage the interest rates, whereas debt monetization, the government spends. It issues bonds, and the central bank absorbs those bonds by just printing money. So the debt, in essence, is monetized. It's turned into money. And that's the thing that every monetary policy textbook says that central banks should never do. It's also kind of what quantitative easing is in a roundabout way. But let me be precise because the nuance matters. When the Fed did QE, quantitative easing, it was buying treasury bonds on the secondary market. So buying it from banks and financial institutions. And the theory is that it's not directly financing the government. It's just adding liquidity to the financial system. So there's I guess a technical firewall there. But, and this is a significant but, the practical effect is similar. The government issues bonds, the Fed buys them up. Interest rates then stay low in theory. So the government can keep borrowing cheaply, and the money supply expands. Now, the line between QE and outright debt monetization is, I think, a lot thinner than people think. Like most central bank economists will tell you that they are categorically different. And they are, but in function, I don't find much of a difference. Like most independent monetary analysts will tell you that the distinction is becoming increasingly like technical, but it's a difference without a distinction. And here's why this matters today. Between 2020 and 2022, during that huge inflation expansion that we had in post-COVID, the Fed's balance sheet exploded from $4 trillion to nearly $9 trillion, mostly in treasury bonds. I mean, it purchased something like half of all of new treasury issuances during that period. So you can call that QE, I think, if you want, but the functional effect was that the government ran a $5 trillion pandemic response, and the central bank absorbed most of it. So when inflation hit, the Fed started unwinding quantitative tightening, basically just letting the bonds roll off the balance sheet. But the political pressure to restart QE is always there. And the more fiscally dominant the government becomes, the thinner that line between monetary policy tool and just paying for government spending with new money actually is. So debt monetization is the thing that can, if done without limit or anchor, actually trigger hyperinflation. It's also, in more modest forms, a tool that governments have used continuously for decades. So the question becomes, how much and under what constraints? So now we have all of the major mechanisms under our belts and the differences in function and intent between them. And that brings us to the players in the game that exist outside of the traditional banking system. So until now, we've really been talking mostly about the Federal Reserve, the Treasury, and large regulated banks that collaborate with them. And then, by extension, the central banks outside of the United States, but still in the very regulated system. The real action, though, is oftentimes outside of these major institutions, the ones that are in the shadows. Shadow banking has a very negative connotation that in some cases is, I guess, kind of deserved. In some cases, not really, because it just means it's outside of traditional banks. So what it refers to is this huge network of financial intermediaries, everything from hedge funds and money market funds to private credit lenders and non-bank mortgage originators, structured investment vehicles, even insurance companies, right? These are all institutions that perform bank-like functions. So they're lending money and they're creating credit. They're holding and transferring risk, but they operate outside of traditional banking regulation. So like they don't have FDIC deposit insurance, for example, and they're not subject to the same bank capitalization requirements. They don't have the same regulatory oversight either. So they're in the shadows, not because they're illegal, but because they grew up in the gaps between the regulatory regimes that we've had over the last several decades. And now they're enormous. Like the shadow banking sector globally is estimated to be around $60+ trillion in assets. In the United States, it's larger than our traditional commercial banking system. There's more credit in the American economy that runs through non-bank lenders than through your traditional deposit-taking banks. So private credit is a great example, and it's also something that you've probably heard a lot more about lately, right? Because it's one of the fastest growing corners of finance. It's also where they said there's going to be some cockroaches running around. When Jamie Dimon said that, everybody was like, oh my God, private credit's going to blow up, and that's the next thing. So you've got huge players, big asset managers like Apollo and Blackstone and Ares, and they've built huge lending operations. They're making loans to companies that would previously have gone to a bank, but they're doing it through private funds instead. It's usually faster, although a little bit more expensive, maybe some lower covenants, not as much collateralization. It's a functioning system that grew up because we started over-regulating the functions of the bank, just specifically when it came to business credit. So it's not inherently bad. But when things go wrong in private credit, for example, there's no Fed window to run to in the same way. There's no federal backstop. Like we don't have the same mechanisms like all the ways that we just talked about before. Now they can get to them, which we'll talk about later, but technically speaking, it's outside of the system. So money market funds, which millions of Americans use as a de facto savings account, also part of shadow banking. So in 2008, a major money market fund broke the buck, meaning its net asset value fell below $1 a share, and panic ensued. So the government had to step in and guarantee money market funds to prevent a catastrophic run. So like I said, even though there's not supposed to be a technical direct mechanism for the Fed to come in and backstop this, it always winds up doing it, which is why these guys, I think, learned from that experience to be like, well, fuck it. Let's just do whatever we want to do because, if everything goes bad, the Fed's going to come in and stop us, right? Backstop us, rather. So anyway, the big question is always when risk builds up in the private credit market or in the shadow banking system, does it become systemic, meaning can it take down the whole economy, or does it stay isolated? But when it builds up, the thing about it, whether it becomes systemic or not, is it always does it quietly. And by the time everything kind of falls apart, it's too late. And how do we know that? 2008. That was largely a shadow banking crisis. Mortgage-backed securities, structured vehicles, credit default swaps, all of it in the shadows. And it's still there. It's bigger now. And nestled inside the shadow banking world is one specific trade that almost no one outside of Wall Street talks about. And it nearly collapsed the Treasury market 3 separate times. Now, the difference between now and then is the sheer volume of money running through the system and the fact that the traditional banks, the ones that hold the people's money, have more restrictions on their leverage into this market. So there's a general sense that even if there is a crisis in the shadow banking system, it'll be contained to this arena so consumers have a layer of protection. The thing is, we haven't tested these new firewalls, nor are we privy to the motivations and the maneuvers of these outside institutions. So our next term is one of those very specific maneuvers with a very specific motivation. All right, this one requires a little bit of setup, so stay with me. The basis trade is a hedge fund strategy that exploits a tiny price difference between treasury bonds in the cash market, the actual bonds themselves, and treasury futures contracts, which are derivative contracts to buy those same bonds, but at a set price in the future. Now, in theory, those prices should be almost identical. And in a perfectly efficient market, they just converge. The basis is the small gap that usually, almost always, predictably exists between them. And I mean, it is very, very small. So here's how hedge funds exploit it. They buy the cash treasury bond and then simultaneously short that same futures contract, locking in that small price difference as a profit. And the strategy is essentially risk-free if those prices do converge. The problem is the gap is so small, I mean, fractions of a percentage point, that to make any real money on these margins, you need an enormous amount of leverage. I mean, 50, 100 to 1, sometimes even more. So there's a bomb buried in this trade, because when markets get stressed, things stop behaving normally, right? When something happens and everybody needs cash at the same time, as we've seen before, investors start selling these treasuries. And that raises the treasury yields and disrupts that price relationship between that trade depends on. So the basis, that little thing, widens instead of converging. So essentially, that trade just goes upside down, and it goes the wrong way hard. And when it goes the wrong way at 50 or 100 times leverage, then you can get wiped out. And to meet margin calls, you have to then sell more treasuries, which widens the basis more, which triggers more margin calls, which forces more selling. It's a death spiral. In the deepest, most liquid market on earth, it's a death spiral, and that's why it spooks people out. Now, this is exactly what happened in March of 2020. Again, hedge funds running the basis trade at massive leverage were forced to liquidate because the treasury market, again, the deepest market in the world, became highly dysfunctional at the height of COVID. So the Fed had to intervene with hundreds of billions of dollars in these emergency purchases within days. And it happened again, but to a lesser degree, in early 2023. So it's not like these things are unicorns, right? These are actual things that happen, which is why there's some risk associated with all this. And so the Bank for International Settlements, which is the central bank of central banks, has been sounding alarm bells about the basis trade ever since then, warning that the total size of these positions might be in the trillions. Again, we don't know. And that's what makes the basis trade a live time bomb. And it's one that on paper is structurally capable of breaking the treasury market in a crisis. Of course, we have the tools to fend it off, but at what cost? And what worries some economists is that, again, we don't know how much of our debt, the treasury bonds that we put out into the market, is being purchased for that purpose. So the two basis trades that are most well known, we've talked about them before, are Japanese purchases of U.S. treasury bonds because of how the yen is valued against the dollar. It's, in that specific instance, they call it the yen carry trade. It's just a basis trade. But also the Cayman Islands. And there's a huge dispute about how much money is actually flowing through the Cayman Islands and by extension where it comes from. So this is the biggest controversy that's out there. And we've covered both of them, as I've said. So it's not a good sign. So let's leave the basis trade where it is. And let's hope we don't have to pick up that conversation again, because again, that's the ticking time bomb that nobody wants to think about. So if we are talking about it again, oh boy, not a good sign. But for our last term, let's bring it back to you and me, to the individuals that are actually affected by any and all of these policies, but can do nothing about them. This is the one that you experience in real time every time you go to the grocery store and think, how much does that cost? Nominal values are raw numbers, the actual dollar amounts, which are scary enough these days. Real values are those same numbers, but adjusted for inflation. Purchasing power is just how much stuff any given amount of money can actually buy. And real purchasing power is obviously what matters because it tells you whether you're actually better off or worse off, regardless of what the numbers say. So here's a clear example. You got a 3% raise this year. Well done. But inflation, the general increase in prices, is running at 5%. So in nominal terms, you made more money. In real terms, you took a pay cut. Your wages went up 3%, but everything you buy went up 5%. So it's more expensive. You could buy less with your paycheck than you could last year. So that's not complicated math, but it's almost never presented like this in public discourse because people just hear wages are rising and now things are getting better. But real wages adjusted for purchasing power are what determine whether working people are actually getting ahead. And here's something that we've talked about a lot that I never ever hear. People talk about the employment rate, unemployment rate, the, effective employment rate, the prime employment rate, all these different rates, right? The fact of the matter is, half of this population doesn't work. Children, students, military members, people that are out of the workforce, disabled people that are out of the workforce, seniors that are out of the workforce, whether they want to be or not, half of this population does not work. So they rely on the income of the people who are working to support them. And so that gap, especially at the lower end of the market, that gap is significant when there's less purchasing power. So this is the exact mechanism behind wage stagnation. Over the last several decades, nominal wages in the United States have risen. If you just look at the number of dollars that people are paid, it was higher than in the 1980s. But real wages, adjusted for inflation, adjusted for the actual cost of housing and healthcare, education, childcare, they've been flat to declining for huge swaths of the workforce. That's that bottom line in the K-shaped economy that everybody's talking about. So it's related to everything that we've talked about here today. Financial repression keeps real interest rates negative, which is great for borrowers, terrible for savers. And when the government runs fiscal dominance and the Fed has to tolerate higher inflation, purchasing power erodes. When the petrodollar system forces demand for dollars globally, it keeps the dollar strong in ways that help some Americans, but then it hurts others. Purchasing power is where all the abstractions land. It's the ultimate score of the game. So when the cost of healthcare increases because of a decline in fiscal subsidies, your purchasing power erodes. When tariff inflation shows up in certain pockets of the economy because importers can no longer absorb the cost, they pass it on, and it eats away at your purchasing power. When the same tariffs lower the value of the US dollar, the dollar in your pocket buys less. When we start a war of choice with the one nation that controls the price of oil and then oil goes through the roof, it crushes your purchasing power. Now, the difference between real and nominal is the difference between what the headline says and what your life feels like. So always ask, is it real or nominal? Is it adjusted? And adjusted for what? These 10 terms are not abstract academic concepts like the Ricardian equivalence. It's not a model of measurement like the beverage curve. These comprise the operating system of the economy that we're all living in right now. They describe the actual mechanics behind why the Fed does what it does, why the government can't just fix inflation by snapping its fingers, why hedge funds can nearly blow up the treasury market in a bad week, and why your 3% raise somehow doesn't feel like it's good enough. The reason this stuff feels opaque, the reason it feels like something other people understand and maybe you don't, isn't because you're not smart or tuned in. It's because there's almost no incentive to explain this stuff clearly. So my goal is to give you the words so you can just follow the argument and decide for yourself who's giving it to you straight and who's using jargon to just cover for bad policy. Sure takes a lot to make this free market work, doesn't it? It's almost like it's not free at all. In fact, I would argue it's the opposite of free. It's complex, opaque, expensive, and exclusive, meaning exclusionary. So beyond the definitional aspect of this piece, I think that's the one thing that I want to leave you with. Milton Friedman, our nemesis, is famous for saying there's no such thing as a free lunch. But if I offer you something to eat from my garden because you're my neighbor, that meal is free, because that's mutual aid. That's collectivism. The truth is, there's no such thing as a free market, because once you introduce incentive structures, all bets are off. We've created the most comprehensive financial system ever conceived, and it's okay to hold two thoughts in our heads at once. You can step back from it and just marvel at the size of it because it's truly a spectacle. It is a marvel. But from that same distance, you can also see how incredibly unfair it is, how perverse the incentives actually are, and how deeply, deeply dysfunctional it can be. The truth is that our financial system is designed to maintain the status quo of wealth. It's designed to keep money moving around the same pockets in a continual stream of liquidity and capital flows. No matter how much jargon they use or how Byzantine the architecture, the purpose remains the same. So I hope this was a useful exercise and that each concept supported the next one like building blocks. And if there's any other terms that either vex you or just doesn't sit right with you, let me know in the comments or feel free to email us at unftrpod@gmail.com. If you subscribe to this channel, I would greatly appreciate it. And remember to sign up for our free weekly newsletter at unftr.com. Thanks for hanging with me today, and thank you as always to the members who support us. We don't gate our content on YouTube, the podcast, the website, or the newsletter, and we don't accept sponsors. So our members are truly the unsung heroes that are trying to unfuck the Republic.
This is the story of a political pundit who looked at the world around him and just said, fuck it. Gives the middle finger to authority and says, kiss my ass. But instead of a revolution, he started a podcast. Just what the world